Okay, and we are back. So we are on slide 15 of deck 6 now, and we're looking at problem 5, and this is problem 5 in handout number. We are on handout number. Okay, yeah, so we're on problem 5 of handout number 13. So it is asking us to look at our problem. And in our problem, we have XCO, which is a CCPC. And XCO has earned $100 of income, which is going to distribute tax-free to its shareholder, Mr. X. The distribution is not paid from XCO's GRIP. And so the income is subject to a combined federal provincial tax rate of 10% in the corporation, and dividends received by Mr. X, and sorry, that's a typo on the side, just say 11%. Dividends received by Mr. X are subject to combined federal provincial marginal rate of 48%. So again, we're assuming Mr. X is the top marginal rate taxpayer, and we appear to be assuming that the corporation qualifies for the small business deduction. Again, that should be 11% in the handout and not 10%. So the question is asking us to apply the gross up and credit mechanism in this example to Mr. X and XCO. So we're going to assume that the corporation is going to make a full distribution. And so on these facts, we're going to have $100 of income at an 11% small business deduction rate. So we know there's going to be $89 of after-tax income remaining that will be distributable to the shareholder of the corporation, Mr. X. And so that means we're going to have an $89 non-eligible dividend that will be paid to Mr. X, again, because the dividend is not being paid from GRIP, so therefore it's a non-eligible dividend. And so that dividend gets included in Mr. A's income, or so Mr. X's income rather, under paragraph 82(1)(a). And we then have the 15% gross up under subparagraph 82(1)(b)(1). And so that should result in a gross up of $13.35. And so Mr. X should have total income of $102.35. So from there, we would compute our tentative federal and Alberta tax payable by multiplying that $102.35 by 48%. And so that should result in tax payable of $49.13. Then we have our federal dividend tax credit under paragraph 121A, which would be equal to 9.03% of the total dividend. And so that should be $9.24. And then we should also have the provincial credit, which again under subparagraph 21C1 of the Alberta Personal Income Tax Act, should come out to 2.18% of the total dividend, which would be $2.23 in this example. And so once you've subtracted the federal credit of $9.24 and the Alberta credit of $2.23, you should end up with combined federal and provincial tax payable of $37.66, which should conveniently work out to 42.31% of the original cash dividend received. So that's part A. And then in part B, we now have YCO which is a non-CCPC. And our non-CCPC is going to again earn $100 of income, which is going to distribute after tax. We're mentioning explicitly that is not paid from LRIP. So we can assume this is an eligible dividend to its shareholders who are individuals. The income of the corporation, the problem says, is subject to a provincial tax rate of 25%. This year, that should now be 23% for 2021. And so dividends, again, are going to be subject to tax, but for the dividend tax credit, the top marginal rate in Alberta of 48%. So we can work through this problem now again. So starting at the top, we have $100 of taxable income in YCO, again, which is a non-CCPC, so we can assume that its income is subject to the general rate. And so that should be $23 of tax payable in 2021 in Alberta off of that $100 of general rate business income. And that should leave $77 of dividend that it can pay to the shareholders. Now, if you stopping here for a second, this is where the stipulation that the dividend is paid from is not paid from LRIP is important, and why, if this were a CCPC, we would have to make some different assumptions here, right? Because with the non-CCPC, we can pay unlimited eligible dividends except we have LRIP. With a CCPC, you're constrained to the amount of your GRIP. And so if you recall, the amount of our GRIP addition isn't equal to full rate taxable income, right? It's equal to adjusted taxable income multiplied by the general rate factor, which is 0.72. And so in this example, if this were a CCPC, and this were the first taxation year, so there was no opening GRIP balance, and there were no other additions to GRIP other than business income, we actually wouldn't be able to pay a $77 eligible dividend because the general rate factor is 0.72. And so you'd only in fact be able to pay a $72 eligible dividend, and you'd have to pay a $5 non-eligible dividend if you wanted to go on a full distribution basis. And basically what's happened here is that Alberta's corporate tax rate is functionally too low, that the assumptions that are, and again, this goes back to last week where we talked about how the entire integration system is based on a series of assumptions. Here, we're assuming that provinces would have a higher corporate tax rate than they in fact do. We had that that 0.72 as a general rate factor. And so you have this situation in Alberta right now where the corporate tax rate is 23, the general corporate tax rate is 23%, where you could have a situation where if you wanted to go on a full distribution basis, that you wouldn't have enough GRIP, even if you're paying tax at the statutory rate and not at some lower effective rate, and you would have to pay some amount as a non-eligible dividend. So that's something to be aware of. Again, it's not a problem here in part B of question 5 because we're stipulating that this is a non-CCPC and we're stipulating there's no LRIP balance. So the non-CCPC is entitled to pay unlimited eligible dividends in excess of its LRIP. So, do keep that point in mind. So anyway, back where we left off, we've paid a $77 eligible dividend. So that's fantastic. So that $72 eligible dividend is, $77 rather, eligible dividend is going to be included in income under paragraph 82(1)(a)(1). So we're going to have $77 there. And then the gross up under subparagraph 82(1)(b)(2) is going to be equal to 38% of the $77, which would be $29.26. And that should give us total dividend income for our individual shareholder of $106.26, which is that 38% gross up plus $77. So then we can compute tentative Alberta and federal tax. by multiplying that $106.26 by 48%, which should give us $51.01. Then we can apply the federal dividend tax credit, which would be 15% effectively of the dividend, and that's 15.02% rather, and that's again under paragraph 121B of the Federal Act. And then we have our Alberta dividend tax credit under subparagraph 21C2 of the Alberta Personal Income Tax Act, which should be equal to 8.12% of the total dividend, which is $8.63 in this example. So then when we subtract the $15.96 of federal dividend tax credit and the $8.63 of Alberta dividend tax credit from our tentative tax payable at $51.01, we should get to $26.42 of tax payable. And that should be 34.31% of the original $77 eligible dividend that was received by the individual shareholder. So hopefully that's all working. And then we have our next question, which is in the handout, and again, it's asking, why do these two examples illustrate, what did these two examples illustrate regarding the gross up credit mechanisms and the rate of corporate tax? And so again, this again ties back to our point last week about what the gross up and credit mechanism in dividend integration more generally are attempting to do. And the difference here is solely a difference of assumed underlying corporate tax rate. So we give a higher credit for eligible dividends on the assumption that they're paid from income that has been subject to a higher rate of corporate tax. And so a larger gross up and a heavier dividend tax credit is required in order to get to an integrated rate. At the same time, non-eligible dividends are assumed to be paid from income that's been taxed at the 11% small business deduction rate. I mean, non-eligible dividends can also be paid from aggregate investment income of a CCPC, but the assumption that goes into setting the rates is that the non-eligible dividends are actually paid from small business deduction eligible income, which can lead to some under-integrate. I mean, it does lead to under-integration, certainly in Alberta, for investment income earned through a CCPC, because we're using an assumed rate of 11%, not an assumed rate of 16%. And so that's where that under-integration is going to come into play. And in fact, that under-integration can get even worse in other provinces where the small business deduction rates are effectively the same as in Alberta. They might be 11.5%, 12.5%. But the rate on investment income after we've refunded our RDTOH is more like 19.5%, 20%. So you can have a bigger gap than what we have in Alberta, but the result is going to be under integration again because of our assumptions about what the corporate tax rate is, since our dividend integration mechanism is not tied to the actual tax paid by the corporation. So then, after that, we then have a final question about why are CCPCs and non-CCPCs treated differently, and what is the relevance of GRIP and LRIP. So we've kind of talked about why CCPCs and non-CCPCs get treated differently. That CCPCs we assume are, we're assuming they're paying tax at small business deduction rates. The default is a non-eligible dividend unless they've got GRIP. At the same time, we assume a non-CCPC is paying full rate taxable income, full rate tax on all of its income. And so its default is an eligible dividend because the eligible dividend compensates properly for the full rate tax payable. But GRIP and LRIP, and this just takes us back to before the break, what these amounts represent, right? So GRIP, again, relevant only for a CCPC and it represents the amount of the income of the CCPC that was taxed, or again, somewhat close to the amount that was taxed as general rate business income. And effectively only general rate business income, because you don't get a GRIP addition for small business deduction income or for aggregate investment income. LRIP, on the other hand, again, like we talked about, only relevant for non-CCPCs. And what it effectively represents are two things. One are non-eligible dividends received from other corporations. And number two is any aggregate investment income if the non-CCPC is a non-CCPC solely by virtue of having made an election under paragraph D of the CCPC definition to not be a CCPC. So that's problem 5. Did anybody have any questions about problem 5? Okay, seeing none, we can then go to slide 16 of deck 6, and we're now going on to problem 7 of our handout. And this is just asking a bunch of conceptual questions, right? That for the most part we've talked about, but we can hammer them home now just to make sure everybody is fully on board with what we're doing. And so the first question is, why is a gross sum of credit mechanism limited to shareholders who are resident individuals? So I think the first part of that is, why is it only limited to individuals? And I mean, the answer here is, I think, really straightforward, that we limit the gross sum of credit mechanism to individuals because corporations generally aren't taxed on dividend income, right? The corporations, because of the subsection 112 deduction, generally don't get taxed. If we run it, if we run our materials before the end of the course, and we want to talk about section 55, we can talk about how dividends might be recharacterized in a way that the corporation could be subject to tax on the dividend. But generally speaking, intercorporate dividends from one Canadian corporation to another are not taxed because there's a subsection 112(1) deduction. And so we have no need for a gross sum of credit mechanism for corporations. The policy design that underlies the taxation of corporations or shareholders in the Income Tax Act is that corporate income only gets taxed once at the corporate level, and it only gets taxed on distribution in the hands of individuals. And so we only care about integration for individuals because only individuals should be paying tax on distributions anyway. So then the problem moves on to ask about non-residents. Like, why do we limit the gross up and credit to residents of Canada and not doing something for non-residents? And the answer here is that we don't know. We have the gross up and credit mechanism for Canadian shareholders. Number one is because we know how Canada taxes individuals who are shareholders of a corporation who receive a dividend. And so we know what kind of relief we have to give them in order to get to something that looks like proper integration. In contrast, we have no idea how a foreign jurisdiction is going to tax the shareholder who's receiving the dividend, if they tax them at all. Right, so non-resident shareholders who are individuals are basically always going to be subject to Canadian Part 13 withholding tax and not Part 1 income tax. And we assume when we impose Part 13 withholding tax that the non-resident individual is going to be subject to either a foreign tax credit in their home jurisdiction, or they're going to be entitled to an exemption from tax in respect of the foreign source dividend income. And so as a result, there's no double taxation. And, in fact, if there's no taxation at all in the foreign jurisdiction, the non-resident probably gets off at a better rate than the Canadian shareholders because they'll pay tax at a maximum effective rate of 25%. So non-residents make up, just fine on this, whether it's, especially if it's an exemption, and if it's not an exemption, since if there's no exemption, there's probably going to be a treaty with that country, and there'll probably be a limit on the Part 13 tax rate, and they'll probably pick up a foreign tax credit in the jurisdiction. And then so it's really just between them and their home country how the Canadian source dividend actually gets taxed net of the foreign tax credit. The other thing, though, is that to think about goes back kind of to week 2, right? And our discussion about the rationale for having a corporate tax at all, right? And the idea that having a corporate tax may function as a withholding tax so that any amounts that would be tax payable by non-residents actually gets collected from the corporation. So if we gave non-residents credit for the corporate tax paid on an integration basis, but then generally speaking, don't have the ability to tax them otherwise and under Part 13, then the non-resident is effectively never going to be subject to Canadian tax, right? Because they're going to get credit for the Canadian corporate tax paid, and there's not going to be any personal tax on dividend received, again, other than Part 13. But so if we're going to provide credits, then we're effectively giving that back. And so the non-resident just never gets taxed. And so that's, aside from not being ideal, because you would usually like to be able to export some tax to non-residents, it does create a horizontal equity problem where you're now just solely taxing your Canadian resident shareholders. So not perfect, right? So we're not going to do that. We're not going to give non-residents any kind of relief. They can pay their pro rata share of the corporate tax, whether they feel it or not, because it's widely held or not. They can pay their withholding tax at whatever treaty reduced rate they qualify for, and then it's entirely up to their jurisdiction of residence to decide how things go from there. Next, question 7 asks, well, why do we limit the dividend tax credit and the gross up and credit mechanism more generally to taxable dividends? Why is this not all dividends? And here there's 2 reasons for this limitation. First of all, if a dividend isn't taxable when it's received by a shareholder, then there's no need to worry about integration, right? Like the corporation may or may not have been taxed, generally speaking, as we're going to see in our next unit. Where a non-taxable dividend is getting paid is because the corporation wasn't taxed either. So beyond making sure the individual isn't taxed, there's really nothing to integrate, right? There's no shareholder level tax to relieve, and there's no corporate tax to integrate. And second, obviously, tying into this point about how the corporation generally wasn't taxed, is that any non-taxable dividends are generally attributable to pools as well. There's a particular pool that we care about, and so it's not like we have this ability to pay non-taxable dividends where there was corporate tax paid on the income that's being distributed as non-taxable dividend. It's just not a concern. And then finally, our last part of question 7 is asking, well, why do we limit the taxation or the gross up credit mechanism for taxing dividends to dividends paid by taxable Canadian corporations? Right, corporations that are not taxable Canadian corporations, those dividends do get included in income, but they're not subject to the gross up credit mechanism. So why we do this, again, it goes to the taxability of the corporation. Given the breadth of the definition of the term taxable Canadian corporation in subsection 89.1, if a corporation isn't a taxable Canadian corporation, then there's a pretty good chance that the corporation hasn't paid Canadian tax on the income that's being distributed, right? And this is not an all-encompassing statement. Like, for example, you can't have a taxable Canadian corporation that is not a you can have a corporation that is not a taxable Canadian corporation that is subject to Canadian tax, for example, because it was incorporated in a foreign jurisdiction and its mind and management is located in Canada, and there's no treaty tiebreaker that would cause the corporation to not be resident in Canada. But, sort of rare examples like that aside, if it's not a taxable Canadian corporation, pretty good chance it hasn't been subject to Canadian tax. And so if there's no Canadian tax paid, then who cares about integration, right? Like, we don't care. There's no need to relieve the shareholders for Canadian corporate tax paid. And we're not going to relieve the shareholders for foreign tax paid. Like, the corporation, if for example, it's a foreign corporation resident in a foreign jurisdiction, it may have paid foreign tax in that jurisdiction, but except to the extent that the foreign corporation's distributions are subject to withholding tax in the foreign jurisdiction at whatever treaty reduced rate applies to a resident of Canada, we don't really care, right? We're not gonna credit Canadian taxpayers for tax paid to foreign jurisdictions. We may, as you'll see in international tax, if the corporation is a foreign affiliate of a Canadian corporation, we might give a deduction to that corporation, again, on the basis that under kind of our territorial system of taxing corporate business income, we may give them a deduction just like they would get under Section 113 when the dividend gets paid up the chain, but individuals get no such relief. So that's problem 7. Did anybody have any questions about problem 7? Okay, seeing none, we can move on to question 9, and this is slide 17 of deck 6. And this one is like purely repetition at this point, right? Why are the dividend tax credit rates in Section 121 different? And it's because of the assumption about the underlying corporate tax rate, right? We're assuming that non-eligible dividends are paid from income that was subject to corporate tax at the 11% rate. And we're assuming that eligible dividends were paid from income that was subject to tax in the corporation at the 23% rate. And so if you're going to try to integrate the shareholder to make sure that the combined shareholder corporate tax rate doesn't vastly exceed 48%, you obviously need a much larger credit for the eligible dividend in order to accomplish that result. So that's problem 9. Assuming that we don't have any questions on problem 9, just because it's highly repetitive, we can move to question 10 and slide 18 of deck 6. And here we have a few more conceptual questions about how our system of dividend taxation works, which again are useful things to think about. And so the first is the first question 10, part of the question is saying just a statement: the dividend tax credit is unfunded by which we mean that there's no connection to the actual tax paid by the corporation. The dividend tax credit is available when the shareholder receives an eligible dividend or a non-eligible dividend, even if the corporation in fact paid no tax on the income. So it's available and it's not tied to the corporation having remitted tax. So the question is asked, well, what are the implications of that? And the main implication of the dividend tax credit being unfunded is that integration will never be perfect. So because the dividend tax credit does not account for the actual tax paid, but accounts for an assumed rate of tax paid, that, on the assumption the corporation has the financial wherewithal to pay this amount, it must have paid tax at an effective rate of approximately X, which is either 11%, or actually, on eligible dividends for a CCPC is actually on the assumption it's paid 28, about 28% federally, and the provincial amount assumes 23%. But in any case, we're making some assumptions here about what the underlying corporate tax rate was going to be. And so you're never, except by pure fluke, where the shareholders has to have the exact right amount of income, you're never going to pay tax at 48% on a combined corporate shareholder basis. If a corporation pays tax at a rate that's lower than 23%, then, or lower than 18%, or sorry, lower than 11%, depending on the type of dividend, the corporation and shareholder combined may well pay tax at a rate that's below 48%, even if the shareholder is a top marginal rate taxpayer. And then on the flip side, it's also possible, and as we've seen and mentioned with investment income, that if the corporation pays tax at an effective rate that is above the assumed 11% or the assumed 23%, then the corporation and the shareholder are going to pay tax at an effective rate that's above 48%. Again, assuming a top marginal rate taxpayer, you may still come to 48%, just not if you're a top marginal rate taxpayer. And so again, and this is something where, as well, part of the DTC being unfunded, part of that being tricky is as well that there's a provincial component. So the provinces, as I think you may or may not, actually you may not know, but as I was going to assume that you did know, is that the way provincial income taxes work is the provinces assume the federal computation of taxable income. So the federal gross up becomes the gross up under provincial law. So when the federal government, the Federal Department of Finance sets the gross up, they're making assumptions not only about what the federal tax rate is going to be, they're making assumptions about what the provincial corporate tax rates and personal tax rates are going to be. And then they're leaving it up to the province to kind of make things work with a provincial dividend tax credit set at the appropriate fraction based on the federal gross up, the provincial corporate tax rate, and the provincial personal tax rates. And so given that you have all these assumptions in play, and you have the provinces that may or may not take integration as seriously as they could, you're going to have some breakdown here, right? And as I used an example that in Alberta, from 2015 to 2019, we caused the corporate income tax rate to go up from what was then 25% to 27%, and we caused the top marginal rates on income to go up from what was then, call it about 39% to what's now 48%. but we didn't change the dividend tax credit rates for eligible dividends. We did for non-eligible dividends, but not for eligible dividends, which actually as a policy matter policy choice is probably defensible. But what happened was that there was a fairly decent gap there in terms of expected dividend rates versus actual dividend rates. So just an example of where, because the whole thing is based on assumptions and there's provincial and federal actors who may not be moving in unison, that you will have breakdowns between a assumed rate and a real rate. And so integration in Canada is never going to be perfect. And that is the primary implication of the dividend tax credit being unfunded. So then the problem moves on and it asks, how can the dividend tax credit be unfunded if it's limited or partially limited to GRIP? And so this question pretty clearly relates only to CCPCs and also relates pretty clearly only to eligible dividends that are entitled to the paragraph 121B dividend tax credit. The non-eligible dividend tax credit is just plainly unfunded, right? Because even for a CCPC, you can pay non-eligible dividend. I mean, obviously subject to the BCA, but there's no BCA police to come audit you and arrest you or whatever. So, a non-CCPC can pay eligible dividends, even if it just doesn't, even if it doesn't have business income and has never paid any tax. But the reason why even the eligible dividend tax credit is unfunded, even when limited to GRIP or limited to the absence of LRIP, is because GRIP and LRIP account only for the types of income realized by the corporation and not the rate of tax paid on the corporation. So as an example, suppose you have a CCPC that has a foreign affiliate that carries on business in, let's say, Barbados. And I mean, it functionally doesn't matter what the corporation was doing in Barbados, but let's suppose it was generating exempt surplus, which is something that will make much more sense to those of you who've taken international tax by the time you're finished with that course. But know this, when you have a dividend from exempt surplus, it's not subject to tax in Canada when it's received by a corporation. It's deductible by the corporation, and an amount equal to the exempt surplus dividend gets added to GRIP. So Barbados taxes corporate income at the very attractive rate of 4%, and it does not impose withholding taxes. So in this situation, our CCPC would have a GRIP addition despite having paid combined Canada-Barbados tax on its underlying business income at 4%. And so, even then, it can distribute all of its profits to the shareholder as an eligible dividend. There's no 0.72% limitation here. That's only for business income. And so you end up with, an effective rate of give or take 39%, rather than an effective combined rate of 48% like you would. So that, again, that's a pretty clear example of how you could have an unfunded dividend tax credit, even if it's limited to GRIP. And similarly, you might have a situation where the corporation has GRIP, but just hasn't actually paid any tax on that income. So as an example, think of a situation where a corporation may have had, here's a good example. Suppose the corporation has, and let's suppose it's the non-CCPC this time. And suppose the non-CCPC went out and carried on an active business, but it bought a bunch of depreciable property. And so depreciable property right now until 2023 is subject to accelerated CCA, which is capital cost allowance, aka depreciation, as a response to the US 2017 tax reform. And so the corporation may, in this case, have no LRIP because it's earned business income, but because it's going to write off the accelerated CCA, it may have zero tax, even though it's very cash flow positive. And so the corporation can pay eligible dividends to its shareholders with no LRIP blocking it from doing so. And the shareholders will get the eligible dividend tax credit, even though the corporation has paid no tax on the income that's been distributed. Now, you might say that's a timing issue because eventually, if the CCA is accelerated, and the corporation is going to get to future years where its effective tax rates may be higher because the CCA deductions aren't there because we've already depreciated the asset in prior years. But even then, the effective tax rate isn't going to go above 23%. We're not going to try to claw back the accelerated CCA. And so the corporation's lifetime effective tax rate is probably going to be below 23%. So there's an example, right, of how that's going to work. And so you can see there again that even though we try to limit eligible dividends in various ways, because the GRIP concept especially is only tied to the income of the corporation, not the tax paid, that it's still possible to have divergences where the corporate tax rate is other than 23%, and that as a result, the shareholders either be subject to tax at a higher rate or a lower rate. And again, there's a provincial component to this too, right? When you think about whether there's how unfunding, even if it's limited to GRIP, and especially when you think about it across provinces. So suppose for a second that we have a corporation that carries on business in, let's say, Ontario, right? And let's suppose it's a general rate taxpayer has a permanent establishment in Ontario, so it's paying Ontario tax, but the shareholder is resident in Alberta. And so you now have this underfunding or unfunding across jurisdictions. So the shareholder who's receiving an eligible dividend paid from GRIP in Alberta is getting an Alberta dividend tax credit that assumes that there was Alberta tax paid at the 8% Alberta provincial rate, when the shareholder has in fact indirectly had the corporation pay tax at the Ontario provincial corporate tax rate, which is 11.5%. And so you're going to end up being under integrated because the combined rate is going to be, well in excess of 48%. And you're just going to, as between the governments of Alberta and Ontario, you're going to have this situation where Alberta is relieving against Alberta income tax for tax paid to Ontario, and Ontario doesn't really have to give Alberta anything to compensate for that. You might have somehow it indirectly come out in the wash through equalization, although both Ontario and Alberta are paying in right now, so probably not, right? So that's another way to think about it too, is when you think about the provincial components of this, that you can see how even GRIP or LRIP are not going to limit the potential for unfunding, and especially across provincial boundaries. So with that, we can go to the final question in problem 10. And this problem is asking, well, this underfunding that we have here, is this by accident or is this by design? And we've talked about variations of this question in past weeks. And I think I still come back here to the answer being that it's somewhere in between an accident and a design. If the system works perfectly and you get to 48%, it is by pure accident, right? There's just no way. You can get reasonably close. There have been times, especially before 2015, when the Alberta rate was 39% and the corporate Alberta corporate tax rate was a flat 10. There were situations where, for both general rate business income and small business income on a full distribution basis, you got to within about 1% of where you were supposed to go. And again, in large part, Alberta having a flat 10% personal income tax rate and a flat 10% corporate tax rate made that very easy, because the Alberta tax rates basically mimicked the underlying finance assumptions, federal Department of Finance assumptions about what provincial income tax rates ought to be. And so it kind of worked, but again, largely by accident, because Alberta had decided that 10% was the appropriate provincial tax rate. At the same time, there's a purposive element to this, right? That the system it's intended to trade off perfection for simplicity, right? The adage being that the perfect is the enemy of the perfectly good. And here we know integration is never going to be perfect, but in most circumstances it's reasonably close, right? Like on small business deduction income, you might be 1 or 2% under integrated or over integrated usually. Active business income, I think you're right now a couple points under integrated, but you're primarily close enough. On investment income, you're more significantly under integrated. But generally speaking, Department of Finance bureaucrats tend not to feel very bad for people who are earning a lot of investment income through corporations. And so, if they're the people who suffer so that we have a more simple tax system, then that's probably a trade-off that people are willing to make. Achieving perfect integration, like we've said in the past, would require a system where you have perfect tracking of the underlying corporate tax paid by the corporation, and a way of attributing that tax paid by the corporation to an individual shareholder who receives dividend, even where there may be multiple tiers of corporations from which that tax has to flow. Again, when you take international tax, we're taking it this year, and I guess in practice, you will discover, if you're not able to take international tax, this is not being offered next year, you will discover that we do have a system like this for foreign affiliates, where we can track how much tax the corporation is paid, how it moves up the chain in the taxable surplus and hybrid surplus worlds. It is ludicrously complicated, right? The people who seriously play in the foreign affiliate space in Canada can fit into a 200-person conference room at the Metro Toronto Convention Centre, or similar size space in Montreal or Vancouver or Calgary. Like that's it. If you needed that kind of intellectual horsepower to do basic private corporation and private corporation shareholder returns, we would be screwed, right? Like we would have an unworkable tax compliance system, and we'd have to go to something else, whether it would be pass-throughs or to a classical double tax system like in the United States, or to going back to what we have right now, having the foreign affiliate system on for onshore business is completely infeasible. Most small firm accounts have hard enough time with corporate tax as it is. And as we'll discover in practice, when a large part of your practice is bailing out small firm accountants. So that's problem 10. And then the last thing we want to do before we go to a break, which I feel is well deserved, is problem 11 of our handout in slide 19 of deck 6. And so here the problem is asking, is the amount of the dividend on which the dividend tax credit calculated net of any expenses? And there's a second part that asks if the dividend tax credit is refundable. So let's park the refundability part for a second, and just talk about the related expenses component first. And the answer here is really obvious, right? Because we've gone through the mechanism, we've seen the legislation. You know that the dividend tax credit does not account for expenses incurred in earning the dividend income, and nor should it, right? Because the dividend tax credit is based solely on two things. One is the assumed corporate tax rate, and the second is the assumed personal tax rate on that dividend income. The expenses that are incurred to earn income have no bearing on either of these things. It might have a bearing on the real effective tax rate if we have our dividend is offset, for example, by an interest deduction that was incurred to acquire the share and is therefore deductible, so reduces our taxable income to zero. That's going to be a situation where the actual rate differs from the assumed rate, but those financing expenses, for example, have no bearing on the assumed rate of tax. So, expenses get dealt with separately outside of the credit mechanism. Then the second part of the question asks if the dividend tax credit is refundable. And so for those of you who are not super into reading about tax lingo, which God, I hope is most of you, a tax credit is refundable if the act contains a mechanism by which it can be refunded. So that's a little bit of tautology, but let me explain what that means. What we have with many tax credits is that the amount of the credit that the person is entitled to, in some instances, is deemed to be an overpayment of tax by the individual, and in some cases by a corporation. We do have some refundable tax credits for corporations as well. And so the implication of the amount being deemed to be an overpayment is that it not only does it factor into the individual or the corporation's tax payable for the year and whether they've paid the right amount of tax net of the credit, but if the person has zero tax payable and this deemed overpayment, then the CRA will actually cut a refund check to the individual who has the deemed overpayment of tax. And so, I mean, we know the dividend tax credit is not refundable because if you go to section 121, there are no magic words, right? There would have to be a subsection 121.2 that says, the amount of the credit of it calculated under, in this case, there would have to be a subsection 1. Is not a subsection 121.1. It's just 121 paragraphs A and B. But we'd have to say, the amount calculated under subsection 1 is deemed to be an overpayment of tax. Like those magic words, they're not there, and so we know it's not refundable. So what that means is that if you are entitled theoretically to a dividend tax rate, let's say you had an income of $10,000 from employment. So you're a student like all of you are, and you, again, ignoring the TOSI rules we're going to talk about at the end of this lecture, if we ever get there, ignoring the TOSI rules, let's say you have a rich mom or dad and you're a minority shareholder in rich mom or dad's corporation and you receive an eligible dividend because rich mom or dad are smart, and but for the TOSI rules, would much rather have paid you a dividend directly to fund your tuition and housing and your cars, etc., rather than receiving the dividend themselves and then giving that money to you, because obviously their marginal tax rate is much higher than yours because they're rich and you're not. So, in that case, if you only have $10,000 of income, and you're going to be subject to tax at the lowest federal rate, and in fact, with the basic personal amount, depending on the dividend, you may not be subject to tax at all, because it'll just be offset by the basic personal amount. You just aren't going to have any tax payable, right? And so your dividend tax credit, even though you're entitled to this credit in respect to the dividend received, there's no tax payable against which the credit can be taken, and so you get nothing, right? Like that's the that's the result, is you get nothing. It's a non-refundable credit. Too bad, so sad, but also not that sad, because you didn't pay tax at all. So what I think the last takeaway from all of this is that this should reinforce this idea that the dividend tax credit is an unfunded credit, right? That if the dividend tax credit was funded and was intended to achieve perfect integration, then we probably would have a refund. Like, we probably would have a deemed overpayment for the federal and the provincial dividend tax credits in order to actually cause shareholders and corporations to pay tax at the combined 23% rate, or sorry, at the combined 48% rate, or at the combined 11% rate plus personal tax to again get to 48% in small business deduction world. And we just don't do that, right? And again, what you see is that Parliament has opted for a system where actual corporate tax doesn't really matter, and where the actual amount of tax paid by the individual also doesn't really matter. But we've just made something that's, it may not feel it right now, but much simpler than the alternatives. So with that, we are now done with handout 13. Does anybody have any questions before we take a break? Okay, seeing none, I'm going to stop recording.